Tonight's virtual REDinNYC networking event. We are so happy that all of you could join us. We have a very distinguished guest, which I will introduce in a moment. But before we get started, just want to take a minute to thank REDinNYC for putting these sort of events together and finding ways for us all to stay connected in these very crazy times. So I want to thank the sponsors of the event: CNA Seneca, Skyline Scaffolding, Champion Elevator, REMAX 100, City Bay Capital, Property Shark, Clean to Clean, Eco Safety, and Hydrotech Environmental. Without sponsors, obviously these events would not be able to move forward, so thank you all for your patronage. I am Karl Iacono. I lead an investment sales team at Marcus & Millichap. I also host a commercial real estate video series entitled CRE Fast 5, which you can subscribe to by clicking the subscribe link below. But today I'm representing REDinNYC, and I'm very proud and privileged to do so. So I really appreciate the opportunity to represent this great organization, and even more excited to introduce our distinguished guest tonight, who is really a real estate icon. One of the greats, I'm sure you all know him. He's been a big part of REDinNYC in the past, and we're really pleased to have him here tonight. So I'm going to give you just a very condensed version of his bio because the accolades are quite long, so we could go on for a long time about Bob's accomplishments, but let me run through some of the highlights of Bob Knakal's career. So he's been in real estate for 36 years. He sold, to be exact, 1,873 buildings, although I bet that number has since gone up since this was written, totaling over 18 billion in asset value. So really tremendous numbers. He's a graduate of the Wharton School. He founded Bob Knakal, a very well-known real estate firm, which was then purchased by Cushman & Wakefield. And then in 2018, he joined JLL as the head of New York investment sales. So like I said, really one of the greats in the industry, and we're very privileged to have you tonight and look forward to hearing all of your thoughts on the market, COVID-19, and where we are. Welcome.
Carly, thank you so much for having me, and good evening, everybody. Hope everyone is safe and well out there during these crazy, unprecedented times.
Thank you. Appreciate it. So I want to keep today as real, cut out the fluff, just kind of give people an idea who are listening, because we've got a wide segment of the real estate industry listening tonight. And everyone's wanting to know where this is going and how it compares to past recessions, past corrections. I think we're all trying to predict what's next, which is very difficult. But I think your particular expertise in history will help us kind of gauge how this compares to other historical events.
Yeah, you know, that's the most frequently asked question today is, hey, what's going on? How is this going to play out? Can you make a forecast or a projection? And clearly the answer is no. Can't make a forecast, can't make a projection, can't even tell you what your property's worth today. Hopefully we'll have more clarity on that in the coming weeks and months. But you know, the analogy that I've used most frequently, Carly, is to say that, you know, we know the house is on fire. There's a fire somewhere, and the smoke is blowing right in our eyes. And we don't know whether just the garbage can next to the house is on fire, or the east wing is on fire, or the top floor is on fire, or the whole thing is burning to the ground. Hopefully not the latter. But we'll probably have more clarity as that smoke clears. We expect the smoke will clear in the next month, 6 weeks, something like that, and get a little more visibility into it. Mm-hmm. Maybe have some data points and transactions that we can look to get a sense of what's happening with the market. But I think in trying to answer questions about where we're going, no one has a crystal ball and nobody knows. All we can do is kind of look at the past, look at history, and see what we've learned from past corrections. And, you know, I've been brokering in the city since 1984, so I was very much in the thick of things during the S&L crisis in the late 80s, early 90s. And that experience was very interesting. The stock market crashed in October of 87. 1988 was a great year. Value was up, volume was strong, and then everything came crashing down in 89. And peak values occurred in 89 in that cycle, as it does quintessentially at the beginning of every correction. Value does appear to be going up. Real value is down, but transacted value is higher, but volume falls off the table. And that's exactly what happened in 1989. Values hit bottom in 1993, 4 years later. And we didn't get back to the 1989 price levels until 1998, 9 years later. And then fast forward to the Great Recession, we started to realize that the market was losing steam. Mid '07, late '07, people were talking about residential rents dropping, oversupply, the uber luxury condo market not having the legs that everyone was hoping it would have. And then in September of '08, Lehman and Bear Stearns fail, and value had peaked in 2007 in that cycle. Value didn't bottom out until 2010, 3 years later. And we didn't get back to the 2007 pricing levels until 2014. So we had S&L crisis, 4 years to get from peak to trough, a Great Recession, 3 years peak to trough, value-wise. And in order to get back to the peak value from the previous cycle, it was 10 years in the during the S&L crisis and 7 years during the Great Recession. So it's really interesting to look at that. Now because this pandemic is unlike anything that we've seen before, it could play out completely differently, but the fact pattern we have from the past may be applicable to what we'll see moving forward.
That's very interesting historical context. Thank you for sharing that. Have you seen any of the pricing discovery start to happen? I mean, I think in the brokerage world, we know it's coming asset class by asset class, and I want to touch on that. But just broadly, have you seen the shifts that those other corrections, let's call it, caused already happening, or do you think we're still in that waiting phase?
I think it takes a while to play out. We're still in price discovery mode for sure. There's one transaction just occurred on the Upper West Side where it was a family that absolutely had to sell. They had a couple of multifamily properties on the market looking for 55 million. They ended up trading them around 38 million. So, there was pretty significant price discount there. But, one transaction and even 10 transactions don't really make a trend. We really would like to see a statistically significant basket of transactions before we draw any conclusions about where the market is going or what pricing is. And I think that at this stage in the cycle, because we're so new into this thing, we really don't have enough data points to point to and try to make any conclusions about what's happened to values or where values might be headed. And I also think that the dynamics within each product type and asset class are going to vary greatly. A big part of my practice is the land practice, and we have active bidding on a number of the properties we're selling, and the diminution in value ranges from anywhere from 0 to 5% on some sites to as much as 50% on others, and it depends where it is, what it is, how big it is. So many different factors come into play that it's dangerous to try to just come up with an aggregate average of what's going to happen to the market. You really have to look at every different product type, different classes within that product type, and it's really different for everything.
I completely agree, and that's a wonderful segue into getting a little more granular on what you're seeing in different parts of the market. Why don't we start with New York City and I guess the tri-state area office properties? I know you're very active and have a great history actually in all the property types, so I'm confident you can speak clearly and give us color on all of them. But office, I think, is a particular focus point. So do you expect a transition to more square footage with social distancing, or less square footage and more movement into the suburbs? How do you think the way we use office space and the square footage requirements might who knows, but might be changing in the near future.
Well, Carly, that's the question of the hour. And, I should also state that the way this market is unfolding, it almost changes hour to hour, day to day, week to week. But, heading into the pandemic, the office sector was one of the strongest in the city. The leasing dynamics were great. We had more investors looking for office buildings than almost any other type of property. And that had historically always been the multifamily sector, always had the most investors, the most lenders, the most activity. Naturally so, because of several factors. One, there are more apartment buildings in the city than any other type of building. Two, a rent regulation created a floor so that the downside was protected. But with the new rent regulation laws that were passed June 14th of last year, it has dissuaded a number of historically focused investors from the multifamily space into other asset classes. Two things that those multifamily investors have done. One, they've started to buy multifamily outside New York City, and that trend started last year, even before the rent laws were changed, because there was so much talk about the rent laws changing that it was scaring a lot of people. They started to buy multifamily outside the city. And the other thing that was interesting is they started buying other types of properties. So for instance, we were on the market early this year with an office building on West 22nd Street, smaller size building, about 65,000 feet. Normally, if we have good activity on a property, we have 100, 110 confidentiality agreements signed. We had 242 signed on that property, and over half the people who signed NDAs on that deal had not ever purchased an office building in New York before. A number of them were multifamily investors. So heading into this pandemic, the office market was really, really strong, particularly for the smaller properties that were bite-sized enough for a first-time investor. If you for 30 years had only bought multifamily buildings, you're not going to buy a 500,000-foot Class A office building. You're going to buy a smaller office building, cut your teeth on that, and a lot of folks were wanting to do that. And so the office dynamics were great. So now the long intro to the answer to the question that you asked me is what's going to happen with office space? Well, number one, I don't think things are going to shift so quickly in the office market, simply because, what's the average weighted lease term for office tenants? If you have a credit tenant and they have a lease commitment and the lease has 8 years to go, they're probably not going to change that occupancy overnight. So that's something that will evolve very slowly. And I think the answer to the question, and clearly there are many, many more questions today than there are answers, but the answer to the question is going to be, what was the experience that tenants have had in this unbelievable experiment that we're going through of having most folks, if not most folks, work from home, the overwhelming majority of people. So did the company have a positive experience? Did they have a negative experience? Did some of their divisions work very well from home and other divisions didn't work so well from home? These are all questions that each individual company needs to answer for themselves. And you've seen some companies come out with statements saying, we're permanently going to have X% of our sales force work from home moving forward. A big national insurance company had said they're going to close most of their offices and have folks work from home permanently. I don't think you're going to see any statement from a company that says, hey, this working from home thing has been terrible for us. Nobody's going to say that. So you haven't seen those articles written. Yeah. But I think the answer to that question of how was the experience working from home, what impact did it have on your business, your productivity, your culture? So many different questions have to be answered. And I think that we're in the process of determining what that experience has been like, how companies are going to operate, what the real sentiment of employees is. And I think that all the surveys that companies send out saying, hey, would you like to work from home or work from the office? I think those are probably very heavily skewed towards working from the office, because what employee in their right mind is going to tell their boss, yeah, I'd rather work from home. I don't want to come in and see you every day. So I think you have to take that feedback with a grain of salt. But I think it will be incumbent upon folks who are running businesses to see, if you look at the way the business expense structure is, the three main expenses: payroll, health insurance, and rent. And if you're looking at profitability, you have to look at rent. And do you need the amount of space you need? Do you need more space per employee? Are you going to go to less densification, which has been the trend for a while, is densifying offices? So maybe for the same number of employees, you'll need more space. Or are you getting more space per employee, but a percentage of your employees will be working from home? These are questions that are unanswered at the moment and will play out very, very slowly because of the length of commercial leases in office buildings.
That's fascinating. And I agree that there's a lot of different factors. The feedback I've been getting seems to be split based on demographics, location, age range, the type of job, and so forth. So I agree. I don't think there's one sort of fit all answer for that, but I do think companies will start exploring other options, maybe taking some of their square footage and moving it around, maybe some smaller footprints in addition to the larger. It's a time of flux. Do you feel that most of your clients are on hold right now as we evaluate the working from home experiment, like you said, and maybe pricing discovery, et cetera? How are you seeing obviously transaction velocity is down for basically everyone, but are you seeing anyone kind of say, okay, we're starting to get enough data, we're ready to move forward on deals, or is everything really on hold in these different asset classes as people are trying to figure out these changes?
Yeah, no, I think there are a number of clients who have capital available and want to invest in this market. It's challenging from a brokerage perspective. As you know, we can't show buildings today. So if you have an income producing property, it's nearly impossible to sell it unless you had been working on it for a while and the buyer had seen the property before, and it's just a matter of negotiating. But to start a new project today is very, very difficult. We have a number of assignments where we've been retained to sell properties. We have done the marketing materials, gotten them ready to go, and just in a holding pattern, waiting to see. We talk to the owners every week saying, nope, not yet, not yet, not yet. We'll let you know when. The only exception to that are development sites, because they don't need to be inspected. You just need to know the land size, the square footage. Maybe you have to get an environmental company in to inspect the property in the event the seller did not have a phase 1 and or a phase 2. So those transactions are happening. And I think the great thing about the real estate industry, unlike many others, like a manufacturing business, for instance, when the owner of the manufacturing business says, all right, let's get back in production, you have to order raw materials, oil the machines up, get everything going, wait for the materials to be delivered, get employees back. In our industry, all we need is for an investor to say, in his mind, in his or her mind, yes, now is the time to do it. I'm ready to buy, I'm ready to sell. And as soon as that decision is made, which can be instantaneous, we're back in business. So we just need enough of those folks to feel that way, that it's time to transact in order to get a healthy dialogue going, get some business moving. So fortunately for us, it's just a mindset. We don't have to get machinery up and running. Agreed.
And it changes quickly sometimes. I'm finding sentiment shifting a little bit already as things start to open up across the country. People are a little more positive that we're coming through this. So hopefully that continues and things do start clicking together. So, Cove, I want to switch directions a little bit and talk about retail, which is an interesting asset class and one that I focus on pretty significantly. So, COVID-19 has been called the great accelerator of change. And what are your thoughts on experiential retail and new concepts that were emerging before, and maybe even new creative things that haven't come out yet? What do you think are some of the experiential or new retail concepts that are kind of fun and interesting to watch as this next wave of retail evolution unfolds?
I think that, the retail market is certainly a very interesting one. Clearly, there's been retail and hotels have probably been more negatively impacted than any other asset class. And I think that experiential retail is going to probably be even more of a draw for folks moving forward, because it's so interesting how we find today under these pandemic situations that even having a video conference and seeing other people is heartwarming in a way. I think human beings miss that interaction. And so I think that when we get back to a scenario where we're able to go and experience different things and interact with people, that's going to be a real draw, and people are going to be, it will gravitate towards that. So I think that that is a positive thing. Very interested. I think the future of retail in the short to medium term is very, very likely going to be dependent upon how many companies actually come back. How many of these stores that have closed will reopen? Will it be 90%? Will it be 40%? I don't think anybody really knows. And, I think that that will really be the lead indicator for what's going to happen. How much vacant space will there be? What will happen to rent levels? And where do we go from there? How will retail evolve? I've heard different things, people talking about how retail may be in some stores appointment only, where they only have a certain number of customers in the store at any one time, and you're escorted by a private shopper, and it'd be a very, very different experience than it had been in the past. Other people saying, well, as soon as we have a therapeutic or a vaccine, the department stores are going to be back to the same way they were. But that is, again, one of those unanswered questions that we need time to pass in order to be able to answer.
I'm sure you saw the news that Amazon was contemplating a bid on JCPenney's. And I think that's a fascinating example of evolution. So from my perspective, retail it will always be here, will always be a core of our society. It's just who the players are and what it looks like is continually evolving. So it's, I think it's a fascinating thing to watch right now.
Yeah, without a doubt. And this is that's the part of this that is very interesting and a little bit exciting is, how is this all going to unfold? We came out with different opportunities, new opportunities from the S&L crisis and the Great Recession. It was very interesting to see how those unfolded and the opportunities that were created and the tremendous wealth that people were able to achieve coming out of those corrections in the market. And we'll see how this one unfolds. I expect that, one of the interesting things when we talked about how the S&L crisis, it was 4 years peak to trough and 10 years peak to peak. And then during the Great Recession, it was 3 years peak to trough and 7 years peak to peak. I think that a big part of the difference was that social media accelerated the pace at which everything became known, everything unfolded. There was more clarity into things because of that. And now technology is even more advanced than it was in 2007 to 2010. So, maybe this will unfold even more quickly, which I'm sure everyone would like to have happen. But things evolve. As much as history repeats itself, it's always a little bit different than it's been in the past. And clearly, these pandemic conditions are nothing like anybody's seen in their lifetime. Very
true. We only have about 6 minutes, and I have a lot more information I'd love to extract out of you for our viewers' benefit, because you're just a wealth of knowledge. Can you comment quickly on your thoughts on the debt markets and financing? Obviously, this is asset type specific, but do you think things are starting to open up? Are we going to see continued loan to value pullback and sort of this flight to quality that we're seeing right now? Or do you think this is just sort of a temporary thing that the banks are in a holding pattern as well? Not all of them, obviously, but a lot of them waiting to see what happens. Where is the debt market in your opinion, and where do you see it going in the near term?
Yeah, again, the debt markets are very, very different, product type to product type, sponsor to sponsor, asset class to asset class. But I tell you, we have an extraordinarily robust debt platform at JLL. And I'm on the debt calls fairly regularly to hear what's going on. There's still a lot of lending going on. The transactions are a little more challenging to do, but that's why you need a real debt professional in your corner helping you. But transactions are getting done. Our guys just did a very large construction loan that closed last Friday. That was great to see. So there is lending going on, and the banks in this cycle, and even during the past couple of recessions, have been much more disciplined than they were, let's say, during the S&L crisis or the late 80s, early 90s, when you saw loan to values that were at 85, 90, 95%, which is shocking to look at some of those transfers. And I read the transfer books all the time. It's kind of like my comic books. But to see what the debt levels were back in the late 80s was just astounding. So I think the banks have been very disciplined. Their spreads have gone up a little bit based on the inherent risk that's involved in the market today. Clearly, there are certain asset classes that will be more difficult to get a loan on than others. But banks are in business to lend money, and I think they're continuing to do so and will continue to do so. And their spreads will be on a risk-adjusted basis. And I think there'll be capital available for good sponsors that are looking at good properties that fit the risk profile the bank's willing to underwrite.
Good to hear. Seeing something similar, so that's great. There's still money out there, and that will continue. Give me your thoughts on industrial. So pre-COVID, this seemed to be the darling of the real estate market. Is that still the case? Where is the industrial market segment right now, and where do you think it's going?
I think if anything, the industrial market has gotten stronger. I think if you look at retail sales, I think pre-COVID, I think it was 10 or 11% of retail sales were e-commerce sales. I know that my in-laws, who are up there in age, have never shopped online, that are now doing all of their shopping online. So I assume that the 10 to 11 becomes 35 or 40%. And there's going to have to be space to fulfill all of those orders and to fulfill them quickly, because somebody rather have same-day delivery or one-day delivery rather than 3-day delivery. So I think industrial is going to be very strong for the foreseeable future.
Interesting. Tell me, let's take it in a little different direction for our last few minutes. Any changes that you have made personally and professionally during this really interesting social experiment of lockdown for the last, I guess it's almost 3 months for us here in the New York area? What have you changed that you think will continue, and what have you changed that you're happy to get rid of when things open back up?
Okay, well, that's a great question. I think probably the biggest silver lining in this work from home thing has been all of the great quality time spent with family. I know I've had now for over 2 months, I've had dinner with my wife and daughter every night. That has never happened before in my life. So I feel truly blessed that that's the case, and want to continue to do more and more of that moving forward. Networking was always a big part of my my professional life, and I love networking, love seeing people. But being out 3 or 4 nights a week for drinks and dinners and stuff like that, the family time is really great. So I hope to keep more of that moving forward. And professionally, a lot of things I've done differently. I prefer not to go into them because I think they're going to really help me coming out of this, and don't want to give everyone those tips.
Come on.
I think you have to clearly reinvent yourself and look at things a little differently. You stick to your core values and your core principles, but you have to adapt to a changing marketplace. This is a changing marketplace, and during this type of change, you have to make some adjustments to what you're focused on, the way you're doing things, how you're doing things, when you're doing things. The interesting thing today is that with this work from home thing, there's no difference from calling somebody on a Sunday or calling them on a Wednesday.
Right.
So the days of the week have almost become homogenous, such that there is no, clearly I have some clients that are observant Jewish folks who will not work on Saturday. But other than that, whether you call somebody on a Saturday, a Sunday, a Wednesday, Thursday, it makes no difference. And I was shocked by that. I started calling people on Sundays because I have so many of these video conferences on Mondays that my Mondays sometimes get washed out. And so I started calling people on Sunday. I'm like, hey, I hope you don't mind. I'm calling you on a Sunday. And they're like, Sunday, Tuesday, what's the difference? So it's been interesting.
So do you think that will be a shift in work culture after we open back up, that the 7-day work week, is this our new normal, that everybody is accessible no matter where you are? I mean, that was kind of going that way already. Do you think that will continue?
Well, I think with iPads and iPhones and cell phones and all the different technology that we have, I always say in real estate you're really never off. Even when you're on vacation, you're still working. You're sitting poolside with your phone and your emails, and so you're never really taking a break. But I think it's important to have times where you are shutting down. I'm a big fan of Stephen Covey's 7 Habits of Highly Effective People. Number 7 is you have to sharpen the saw. You sharpen the saw by having some downtime, because if you just worked around the clock every day, you're not going to be productive. But I think that this may be something where the weekend isn't quite as weekendy as it has been in the past, because I think folks will work a little bit of time from home once in a while. And so I think weekends may be a little more active work-wise than they've been in the past.
I think you're right. We are coming up at the half hour. It was a short time today. If anyone has any questions they'd like to put into the live chat window, we'll just scan through and try to get to any of those in the last minute if there are any. I don't see any yet. So any closing thoughts, advice, anything you'd like to share with the group as we wrap up?
No, I would say just realize that in times like this, great opportunities are created. You have to work maybe a little harder, a little more creatively, but there's great opportunity. From a brokerage perspective, every time there's been a major correction like this, a year later, 20 to 30% of the brokers are no longer in the business, so there'll be less competition for us. But I think the most important thing is just stay safe, stay healthy, be careful about what you're doing. I had Corona for about 17 days. Fortunately, didn't get into my lungs, but it's a serious thing. I had fever for 12 days in a row, and feel very blessed that I'm fully recovered. And just take it seriously, but stay safe, be well. And Carly, I thank you so much for having me on today.
Thank you so much for sharing your thoughts. And I will say you look like the picture of health now. So we're all very happy that you came through and everything was okay. Happy you're doing well. So thank you again for all your time and your insights. We really appreciate it. Always nice to see you, and look forward to connecting again soon.
Great to see you as well. Best of luck to everybody.
Thanks to REDinNYC as well. All right. Good night, everyone.